How is your Ohio? How is your Columbus, Ohio been for summer? Are you summer weather, high heat summer weather? Are you like us that you've had rain for the last 18 days?
Well, it's Ohio, so if you don't like the weather, you wait an hour, right? But right now we've got rain, but we just got off that big hot streak that everybody else got off of. So it's I kind of welcome the rain. It was way too hot there for a couple days.
You can send the hot my way. We've had the weirdest weather so far, but we had a weird winter too, so who knows? Hey, everyone, thanks for joining us. This is the last week in mortgage today. We're going to give it just a couple more seconds for some people to filter in. We've got a large number of people, it looks like, popping in here right now, so we're going to give it just a little bit more time. Yeah, we seriously have had 18 days of rain in a row. Which is so unusual for Minnesota, but we also didn't have a lot of snow this winter. We just had cold. And so the lakes are enjoying it and at, a nice level and not low. But I'm like wanting the sun. Where is my summer sun so that I can have tan skin? It's not here yet. So
It's yeah, we've had the opposite side. We've had our I think our hottest, earliest heat wave in a long time. And so, but I think half the country's been under that. So
yeah, Mike, I'm gonna send you rain eastward. I'm gonna try to get that path to go a different way. All right, well, I think we will get started here. Um, and then snow tomorrow. Oh, please. No. No, I'm not wanting for that anytime soon, as you all probably know. It's just a great pleasure today that I always love to talk to Tony Butler, who is the president of the Equitable Mortgage Corporation, who is with us today. Tony, thank you for doing this with me.
me too. Thank you for having me.
Yeah, we always have such great conversation. The time always goes so fast. And, you're one of the people in network that, like, when I'm looking for that real answer, or we're looking for that real answer, we usually find us reaching out, and you always send us such great ideas of things that we can do within the network too. So appreciate you and appreciate that you would hop on here. You tell us just a little bit about the Equitable Mortgage Corporation. You've been
So
there
equity,
for your
yep.
whole career.
My whole career. So I started here. I was waiting tables on the owner at the age of 20. Long story. I'll get into that. That's a funny story. And he hired me. And I've been here ever since. So I started off with just being a loan officer before I could drink, moving up, sales, IT, compliance, operations. Now I'm president of the company. 26 years, if my math is right. If I would have kept my first mortgage, it'd almost be paid off, but I didn't, right? But yeah, so I'm just kind of, just family owned company where, we just do things the right way. We're more of an advisor company. We're not big on sales. We're regional, probably do about 225 million this year. Hopefully do more and, always recruiting for the right people.
Yeah. Yeah, that's always nice when we'll talk in a little while. We've got a topic today that we'll talk a little bit about culture and compensation and some of those things. But yeah, you guys you've been with us since December of 2016. So yeah, so in the very early ages of when TMC got up and running, and like I said, always appreciate your input. You had a brand new experience in the early part of June. And you were one of the lender members that went with some of our team to DC to visit with all of the agencies. This was the second year that you did that. I wasn't there this year. I was there last year, though, with a few people that had been their first trip of that kind. So I'm interested in hearing, with that being your first experience to be able to do that, kind of like, what was your favorite meeting? What did you get out of it? What did you find, that you were expecting it to be something and it was something different? Just kind of share with us what that was like for you and what you heard.
Absolutely. First of all, it was an honor to go. I eat that kind of stuff up. I'm a compliance brain, I'm a sales brain, so I'm always splitting the baby in half, trying to keep both departments happy. You know how that is. But I'm also very blunt and very real to regulators. Almost not even to a fault. I think that's why they brought me there. But my favorite thing was probably when I met with Sandra Thompson with the FHFA. She was able to grab facts at the tip of her fingers like I've never seen somebody do that. And they were right. Like I'd question something and she fired right back. I'm like, okay, all right. And it was refreshing. Like she understood what we were there for, and she understood our spot in the market. Matter of fact, she sat down and she said, "We don't have a lot of time. Y'all know me. Let's talk about what you came here for." And everybody else wanted to, tell me how great they were, and I just really respected that. She was a breath of fresh air. She was really, really amazing. The CFPB was very interesting. Sandra Thompson, I'm sorry, Commissioner Gordon at FHA was phenomenal. Really, I couldn't have had a better experience, and it really taught me the importance of all of us little companies, right, that make up the Mortgage Collaborative to get our voice heard on what we feel on these regulations and proposals. Because when we don't talk, the big lobbyists do, and that was my biggest takeaway.
That's a very solid point. I think that yeah, when things get busy and overwhelming and everything, everybody just kind of buckles down and does their business, and as it needs to be sometimes. But at the same time, you kind of can't lose track of everything else that is going on, because you're right, the large entities have lots of people that are maybe just focused on that, where as most of our lender members wear a large variety of hats all throughout their day, and you need to not forget to put that on. I'm glad you had such a great experience. I will have to say that Sandra Thompson, in anything that we have asked her to do, has been a breath of fresh air. She always says she has 30 minutes. We usually get her for 45 or so and stress out her staff same time, because I think she likes talking with our group and just gaining that different perspective. Before we came on here, we talked about that it hasn't always been that way, right?
It's true. Yeah,
Yeah,
it's been much more adversarial
yeah.
in decades past. Let's just say that the further we get from 2008, the better it gets for us. And the one thing I liked about being in DC is we weren't the enemy of everybody. Everybody's mad at homeowners insurance. So for once, us mortgage people are not the worst people in the cog or in the chain. So everybody relish on that. Even though homeowners insurance is tough, at least it's not on our shoulders for once.
Yeah, I heard that. I don't remember. It might have been Erin D. I don't know if Erin's on here today, but it might have been Erin D that shared that she felt like the first time that some of the focus of, oh, she is, I believe it was Erin, and correct me if I'm wrong, Erin, but some of the focus was not as much on us from like the PB perspective. It was more on other people within the industry that are having an impact on those consumers. So I think that's a big shift too. It's like where, there are now other people involved in some of those conversations related to the consumers. Yep, third parties for sure. See, I do remember some that people
And
tell me.
And to jump on that, everybody on here in your organizations, get the word out for everybody to put in what they think about the junk fees the CFPB is talking about, because the junk fees they're talking about are title insurance. There are things that have been mandated, like AMC fees. There are all these things that we have to do, but we need to make them realize that they're not our fees. They are the third parties, because they only see the settlement statement or the HUD or the CD. Get your voices heard. It's really important right now.
Yeah, yeah. Well, thank you for that. I'm glad you had such a great experience. And we always like it when people that are going to be honest and tell the truth and share their experiences go with us. Because that's kind of what makes it work. So appreciate that. We were talking a little bit before we hopped on here, that I read, and it quickly read, people, so I didn't read the whole entire thing. So I only read the headline, which we all know is sometimes can be very deceiving. But there was a survey by the MBA, and it suggested that 59% of mortgage companies in the industry in the first quarter were profitable. And to me, that seemed like a really high number. And you had some ideas about why that may be the right number, but it may be high for other reasons. So I would love it if you would share with everyone.
Yeah, the most recent number I saw, which was not first quarter, but it was year end of 2023, was 22% of all mortgage operations after you strip out mortgage servicing income were profitable. So when you put in mortgage servicing income, it kind of hid some of the losses, and that's probably where that 59% or 55% comes in. Uh, that should be interesting to see how that shakes out. I
Yeah.
find that to be a high number as well.
Yeah, and I'll do some further digging into that probably for next week and see what that contains. My other thought process was that around the fact that sometimes when those surveys are published, you need to be really cognizant of who is included in that survey. And it just literally may not be that it's of the people that were surveyed, but not necessarily the entire industry, which, sometimes, like you mentioned before, not everybody has a focus on the smaller lenders, that volume and those kinds of things may have a much bigger impact on their financials up and down more quickly. So, yeah, so that could be it too, but I'll do a little bit more digging into that. This week, FHFA said that they agreed and approved the Freddie's second lien program. Um, Kind of an interesting concept. It is a pilot. 18 months, I believe, is the time frame that they've given for the pilot. It seemed like to me in reading it that it wouldn't really hit a large percentage of borrowers, but share with me what you know related to that and what you've read.
Well, I was shocked that they came out and approved that after being, but anyways, from what I understand is Freddie will only be able to do the second mortgages on loans where they own their first mortgage.
Yeah.
So it's pretty much read between the tea leaves. If Freddie does it, Fannie's going to be allowed, right? So I mean, they're both going to be, because how can the FHFA oversee both agencies and say only this group gets this relief? So that's coming. I'm pretty sure it's going to be Fannie also. I think it's little too late. I think most people have their home equity lines and their second mortgage. I think there's enough private capital out there that I think this is kind of out of scope for the agencies. I would rather they not do it personally. But we'll see where it goes, right? I mean, everybody's starving for volume right now, including the agencies, and they need stuff to securitize.
There also was, I read, a maximum loan amount set on that. Now it is a second, but maximum loan amount on the second of 78 to 77. So I don't know if you think about it, you start working the numbers, it's Freddie only right now. They have to have the first. They've capped the max loan amount. I don't know what that does to the pool of loans, but I would think that, and 20, thank you, Michael. 24 month seasoning. So, yeah, so, when you start adding in all of those things, it makes me wonder, how much of an impact that would have, but they're doing it as a pilot. So, we'll see what
My
happens.
my my one hope is this would extend credit to those who need it to maintain their house and keep their house, not give it to the overqualified that can get it anywhere. So,
Always
um,
wonder about
you,
that.
kudos to them for trying. Right there's a lot of pain out there with inflation and everything. People need help.
Yep, yep. Speaking of that, the next thing that we were going to kind of talk about is denials of mortgage applications. We're going to try to keep this in a positive way, folks. But denials of mortgage applications related to high DTI. I would imagine pretty much everybody's probably seen some of that it's not like isolated with all the other things. I mean, I think I know what the factors are that would come into play in that, but would love, as always, to, hear it from you, who is working in a shop every day and seeing it and hearing it from everyone.
Well, property taxes, at least here in Ohio. So one's a government factor. Two is homeowners insurance has been taken for granted in our industry for as long as I've been doing this, that it just shows up the day before closing and it's cheap. Not the case. That's elevating DTIs. You have move up buyers that are house hoarding, in my opinion, because they've got this real estate. They don't want to let it go. They want to throw a realtor in, or sorry, a tenant in and rent that property and keep it. So they're stretching their debt to incomes. Also, wages just have not kept up with inflation, period. And it's tough. You got a lot of side gigs. You got a lot of people working two jobs. Interest rates this high. I think it's amazing that interest rates this high. It would be a novel concept that debt to income ratios are this high. Only in the world of. I'll just stop there. I just think it's amazing that correlation took this hard to come to.
Yeah, I mean, there's just a lot of factors that are playing in there that I heard somebody say this last week. and it was someone in my friend group that their homeowners insurance was almost the same as their taxes. They were just, they were absolutely shocked. And they're like, I haven't even filed a claim. I haven't filed a homeowners insurance claim in 15 years. And yeah, so I thought that that was kind of unusual that it's not just us anymore in the mortgage space that's talking about these things. It has gone high enough that people street level have begun to really notice the big, I mean, between that and food and everything else that runs your household.
Yeah,
Um,
we're starting to see something new, which is like a declining replacement value for for roofs. I don't know if you've seen that, but
uh,
basically, from what I can see, the insurance industry is done giving everybody free roofs every time some hail comes through and some storm chasers. So, that's going to be big. That's something a lot of people have never been conditioned to budget for. I think FHA told us one of the leading causes for delinquencies right now are the surges in the escrow accounts due to huge increases in the homeowner's insurance. If you take somebody that's already at a 45, 48% debt to income ratio in year one, one of the regulators said it's basically like tying a 1 year arm to the homeowner's insurance, and you never know what that debt to income ratio is going to be because the insurance is going to keep going up and up and up. That's interesting.
yeah, and you combine that with other factors. It's not just the insurance going up. It's, people's household expenses are going up. I love all of the comments in the chat, by the way. Everybody keep it coming. People are carrying a lot more credit card debt than what they have in the past. And you add all of those things together, and it kind of becomes a perfect storm for some individuals, um, unfortunately.
It means
Um,
refinances are sooner. That's all.
that's a nice way to look at it. That's a
It's
nice way to look at it. That,
it's going to take its toll on the consumer. Once the consumer stops spending, everything else, all the dominoes always fall, always does.
yeah, yeah. And Alice, thanks for sharing. Never filed a claim and your homeowners went up 45%. I'm afraid that is probably, more the norm and not an exception at this point in time. Are there things that you're doing in your shop? Now you said at the very beginning that it used to be that insurance was like an afterthought. And it was like, it was that last thing that every consumer needs to do that you're doing 2 days before you go to close on your loan, um, which was just to get an insurance cert. And I mean, like it or not, I think that's how most people treated it in the past. And obviously things have changed. Are there things that you're doing that to kind of change up your process because you feel like you need to address that in the beginning versus just having it be a, add-on task at the end?
Absolutely. So I am trying to coach my real estate partners because I actively originate as well, but I'm coaching all my realtors to actually pair them up with a professional. If they don't have one, I will. And part of the pre-approval process is get that baseline quote, but also get a better quote in your inspection period. Like I had a client that they got denied everywhere except for one carrier because of the age of the roof. This was 4 days before closing. There is no out for that because if you can get insurance, you're not denied. It's not about the premium being acceptable. We're moving that a little bit more forward in the front of the contract for the inspection period because if your insurance premium is going to be 5,000 when you thought it was going to be 15, as a consumer, you deserve to know that when you have an out. So we're trying to move that further up.
Well, and you just brought up a really good point that I think also was part of the process before. It was just assumed that you were able to get homeowners insurance. It was an assumption that it's just going to happen. Do you see in the people that you're working with that the insurance providers, not only are tougher maybe to get insurance, but the things that they're looking at, like an aged roof, are stricter, and that's also probably if you get insurance that's probably also driving, I would think, the cost of your insurance higher if they will insure you.
1,000%. And what I would encourage is anybody on the call that's in originations or has loan officers, send your loan officers out or bring insurance agents into your meeting and talk about what it's doing in your local markets. I'm here in central Ohio and I thought I was immune because it's just a Florida thing, right? No, we had some bad tornadoes, right? And we're going to start seeing it and it's nationwide. I would encourage everybody to talk to your local partners. You're going to learn a lot.
Yeah. I think that, yeah, you always assume, I think just because you don't have weather in your area also is not necessarily a factor anymore. Because I think while that was the case before, that you could assume that New Orleans, Florida, California, off the shores of North Carolina, some of those places that have had weather impact in the past, you probably always knew that there was probably a cost associated with that, but I believe that the impact has gone more globally, and whether it's to cover some of the costs in those other places because everything's escalated and everybody's kind of paying the upward fee, or people are not sure what the weather is going to be where they live and the impact on that, because it does appear like places we were talking at the beginning of the show, what your weather was before, there's not as much of a correlation anymore, that they're kind of like pre-planning for things that may happen in some of those markets, and moving the scale of those fees up. Let's talk a little bit about kind of, employee bases and, um, it's like, how has what's going on in the mortgage industry impacted employee comp? Now, I heard someone last week share that there's still somebody out there offering like decent sized bonuses to LOs coming into organizations. And I thought that was all over a long time ago. In your world, is that all over?
It was never in my world, first off. I will say that confidently.
No.
But there, I did make exceptions to that. I'm the type, I just I don't know, I've never been given a check just for breathing, right? Let's just call a spade a spade. What I am seeing though is it's really hard to predict what somebody will do based on the last 12 to 24 months because this market's like nothing else. And those signing bonuses and stuff, what I am seeing is they're promissory notes that are clawbacks on them, and they're usually done, and this isn't meant to offend, it's just what I'm seeing, but they're usually done more on a P&L basis where there's an ability to ratchet the interest rates up, so you have this perceived way of capturing it back. But when you price your interest rates up here and everybody else is down here, you actually lose your ability to recapture it. So that's a practice I wouldn't want to try to manage. That'd be tough.
Seen like, I mean, I know that you've had consistency and you did some things so that you weren't necessarily in this, wave that we usually go in up and down and up and down. What have you seen with like other people, whether it be processors, underwriters, from a compensation standpoint? What do you kind of see happening with that in the area that you're in?
We haven't made any wholesale changes. We've always been an organization where everybody's in it when the production's there. So if anything, this longer sustained downturn, it's just been much more brutal on the operations team because they don't have the ability to work extra and go get another loan. They can only work on what's been brought to them. I'm very sympathetic on that side. The loan officers, we can just get up earlier. We can go out. We can network. We can try to get in more business. But it's been really tough on operations. I'm just blessed to keep my people together. We did some voluntary senior leadership, huge reductions to get through. So that helped because the pay reductions always start with me and then move down, not the other way around. And it's just what you do because I wouldn't have made it living and breathing through 2020 without this group. And I can't leave them behind now. But it's been rough. I think everybody on here, if you're still in the industry, you've had a challenge. It's not just me. This has been a tough one.
Yeah, I think literally for everyone. And I think, people may look at this a little bit different, which it sounds like it's the way that you've always reached it. Be fair with your employees. They have a great wage when things are good. They also continue to be at least in an okay spot and know that someone's thinking about them, maybe when it's not so good. And I think that's a way that you maintain your culture. You don't shuffle people in and move people out. I think that plays in the favor of some of our lender members going forward. I know I spent 25 years in a large shop entity. I won't say which one, but you'll probably always know. I was just talking to somebody about this yesterday, that the model there, I managed a team of over 100 people at one point in time on the upside. And the model there was 40% of it was temporary employee. And then, they kind of cycled in and out. And then when there was no hesitation at all, which is why it wasn't the culture for me. But no hesitation in and out on the seasonality of things and, laying people off and then adding people back in, and retraining. And I think in some ways, our lender members within our network, they could see a gain from that because I think people are tired. They're tired of doing that cycle. And there aren't many people in the mortgage space anymore who haven't been laid off at one point in time or another. And I think people are looking at their home different. The home where they do their work, they're looking at that differently and maybe even analyzing it a little bit differently, even from the LO standpoint, which I think is kind of the last place. That's the place where you've always seen a lot of transition because of money. I'm hearing and seeing from people maybe that LOs are looking more at my life, my family, the culture of the company that I'm putting my name and have a brand with. I don't know if you've seen any of that, but I think that's more of a trend right now.
I agree. I'm seeing that. I mean, it really comes down to culture and it comes down to, transparency and treating everybody the way you want to be treated if you're doing that role, period. And that's how you keep a functioning culture in a fun company. I like to wake up happy. I don't like to wake up mad, right? Start
I
to
love
my
that
people.
about you. We talked about a few topics today, and it's like, nah, scratch that. We're not gonna we're not gonna go there. We're not gonna talk about that one, because let's try to stay in the most positive environment that we can. One of the things that happened that's positive, we just have a few minutes left today, but that happened this week, is HUD provided $10 million in grants to promote housing counseling for people. And so the $10 million went to 65 public housing agencies in 32 states. Ohio had 5 of those. Ohio was 5 of the 65. And this is a little bit different than maybe what some of the things that we've seen in the past. It appears like, anyway, based on what I read, it's more based on safety and security in those neighborhoods. Um, versus kind of like more of a standard, I would say, DPA assistance to get into the house. It's more focused on things like security systems, surveillance, fencing, lighting. Some of the neighborhoods you guys should, let me know if you want to know. The article was published by National Mortgage News if you want to look for it. And it noted in there the reason why I thought was kind of interesting, why that public housing agency earned what the criteria kind of was, that they earned it. And some of them were safety, security, crime was another one, to try to make those neighborhoods better than others. I would assume that you probably would support something like that in your Ohio neighborhoods. Share with me how you feel about that $10 million going to the 65 public housing agencies.
Two thoughts. One is why is it only $10 million? And secondly, why isn't well, no, I love it. I love it because I think 2008, anybody that went through 2008 knows that society gains nothing by taking a home away from somebody, right? So if they're not safe in their neighborhood and they don't feel safe, they're not going to maintain their asset. If they don't maintain the asset, they lose their generational wealth. So anything that we can do to kind of get everybody mind right and like keeping their neighborhoods and their houses in good repair so everybody can lift up on that rising tide, I'm all for it because I sure know the government spends money on far a lot worse things. So like if this is going to go back to citizens and make their lives better, I'm all for it.
Yeah, the other thing that I thought about it too is kind of like not how it was promoted or not, maybe the unintended consequence of it is I thought, what a great thing to help some of those neighborhoods feel safer and be safer, actually be safer. For not only the kids. I always think about the kids, but that's just the person that wants to be a grandma speaking. But only the neighborhoods in and of themselves, in that it may bring more people into that neighborhood. It may make more housing in that neighborhood appealing to other people that are so desperately, looking for a house that they can afford at this point. So if you make the neighborhood safer, it might allow more of those opportunities as well. So that's kind of what I was thinking of as I was reading that article, that good for those individuals that are going to maybe have a little bit more security um,
Absolutely.
moving forward. We're at the end of our time.
How does it always go so fast? I don't understand. And usually nobody gets in a word with me. So like kudos to you. Like you keep me in check. It's pretty impressive.
I don't know about that. I don't know about that. I would say maybe we're two of a kind, but I sure do appreciate you and appreciate you doing this today. The conversation is always good. I always love it when it's 30 minutes that I feel like I've spent with a friend just chatting about the things going on in our industry. So you'll need to let our team know what we can do to help you. For everybody on the call, I loved all of the comments in the chat today. It was so nice to have you all engaged in the conversation. Come back next Tuesday and do the same thing again. Thanks so much, Tony. Appreciate you.
Thank you.